Hey, what is up everyone? It's David here. Buy now pay later stocks literally went to the moon today, so I wanted to do a quick video to explain why I think that is the case and whether the rally is sustainable. On top of that, towards the end of this video, we have to talk a little bit about Michael Burry coming out to talk about meme stock crash again. So as usual, if you do learn something new, it would mean the world to me if you could gently smash a like button somewhere around here. And no, this video is not financial advice or recommendation to do anything. So without further ado, let's go. As many of you know, Zip is up almost 14% today. And for a $5 billion market cap company to move that much, I'm expecting some kind of announcement, some kind of partnership, some kind of speculation, something that gets investors really excited about the company to move that much. At the same time, I think it's worthwhile mentioning that it's not just Zip. Afterpay is up 3% today, Sezzle is up 6% today, and if you look at some of the other technology companies, they're also rallying. And I think I know the reason why, but we'll talk about that more in just a second. So to discover the reasons why companies like Zip is actually moving towards a certain direction, I like to go to Google, search for the company, and I like to go to asx.com. And what I'm looking for in the announcements is if there is anything that would have contributed to the move upwards. Partnership, fundraising, or institutional interest of becoming a substantial shareholder, those all can be contributing factors to why a stock moves towards a particular area. Like for example, if an institution have bought more than a 5% stake in the company, they have to submit a form to basically let ASX know that they are becoming a substantial shareholder. But we didn't get one of those. Maybe in a few days time we might actually see one, but right now I'm not seeing anything that have, at least in announcements, that have really moved the share price. So I dug deeper and I realized that there is speculation on the streets, if you will, that a strategic investor is slowly accumulating a 4% stake. And the whole thesis, at least according to this article, is to give that company the option that if the buy now pay later sector consolidate down to 2 or 3 main players globally, they have a stake in whoever that winner is. From my perspective, I do think that buy now pay later is winner take most. The smaller players will ultimately consolidate into the bigger players. I just don't think you can have tons of smaller players coexisting. Nevertheless, this article is speculating that Kalana is the most likely candidate because it makes sense for Kalana to own a stake in Zip because they are one of the top buy now pay later companies also. And on top of that, they can actually afford it. So if you scroll down to this AFR article, they actually mentioned that, well, Kalana raised $639 million from investors, including SoftBank. And a 4% stake actually equates to approximately $160 million based on when this article was written. Now, there's no substantial evidence that it's actually Kalana. It could be anyone else. It could be SoftBank. It literally can be anyone. So instead of believing in the speculation, I'd rather wait and see. But this speculation that's happening within the investing community, I think have definitely contributed to this run upwards. But I think what have contributed more to this move upwards is actually bond yields. Now, if you look at the Australian government bond yield, the 10-year one, you can see that's been declining over time. And if you zoom into like the most recent bond yields, it's actually a pretty sharp drop. Now, what you need to know is that when bond yields go down, it's great for growth stocks like Zip and Afterpay, right? But if bond yields go up, that's not good. That's not good for growth stocks like Zip and Afterpay. And you probably have witnessed that early in the year when Zip and Afterpay got absolutely smashed during March or even April when the bond yields were really, really high. So bond yields are decreasing. That's great. And I think that is a big contributing factor to why Zip had a very strong run upwards. Another thing I want to talk about, and I'm going to go against conventional wisdom here, is Michael Burry reiterating his crash prophecy for meme stocks. And I'm going to quote him here. I don't know when meme stocks such as this will crash, but we'll probably do not have to wait too long, as I believe the retail crowd is fully invested in this theme and Wall Street has jumped on the coattails. We're running out of new money available to jump on the bandwagon. So this is really interesting. If we look at a meme stock example like AMC, the whole idea of a short squeeze is that you want the share price to stay elevated for a long period of time. Because the longer this goes on, the more elevated it goes. Well, if it keeps going up, then it forces the short sellers to close their position by buying back the stock, which will shoot the share price up even further. Or if you drag this out long enough, in order to keep the short contracts open, you have to pay a premium or an interest to the broker every single week or every single month, depending on the contract, right? So the longer this goes on, the more cash it bleeds. But my problem with this whole situation is that Wall Street plays both sides, and they always play both sides, right? So they can pump the stock up on the way up. And as retail investors are seeing that, oh my God, this is going up, I can make a quick buck by, jumping on the train here. It's not just retail investors playing. Wall Street is also playing, and they're probably doubling down on the way up. And what they can also do is they'll short on the way down. They'll reload at the top, double down on the shorts, and short all the way down. The issue is institutional investors have more tools, they have more resources to wait it out, to drag it out longer. And I don't necessarily know whether retail investors have the resources or the patience to let this pan out, right? And when Michael Burry is talking about new money, there's not enough new money to jump on the bandwagon. I think ultimately what he's referring to is when we look at the personal income for US, you see these spikes here. April, there was a spike. Jan, there was a spike. March, there was a spike. Some of these spikes are generated by stimulus checks. These stimmies are excess income for different people. You can either spend it or you can invest it, right? Either way, these spikes, I think, would have contributed to the excess income that some investors can choose to either gamble it with or invest it. But as that income wear off, a lot of the money that the US citizens have is more likely is going to go towards essential goods and services, right? Because if you don't have as much excess income, why would you spend that in investing in something that you may or may not get your money back, right? You want to take care of your essential needs first. So what I'm trying to say is that personal income is coming back because stimulus is wearing off. So ultimately, I don't think that there might be enough resources, enough patience, or even enough money to keep this elevated for a longer period of time so that the short sellers are forced to cover their position. It almost looks like it's starting to lose momentum now. I don't really know whether this is the end of it. At this point, I have to say that it's not unreasonable to expect a meme stock crash coming soon, just because of not enough new buyers to jump on the bandwagon. Thank you so much for hanging out with me all the way to the end. If you did learn something new, consider gently smacking the like button right there. Subscribe to my channel, click onto the bell so that when I release future videos, I can let you know. If you're still bored, I left a video on the screen that I think it's incredible to watch next. And as usual, Otto will always do the honors, and I'm gonna see you very, very soon.